viewers, I am Sanjeev Pandya welcoming you to this week's edition of the Tax Talk by AJ right here on ITV Go on your favorite TV channel. The show is brought to you by Sai CPS Services. You must have heard by now, Sai CPS Services is one of the most professional and very, very thorough detailed CPA firms in the state of New Jersey, multiple locations, and they can assist you with any tax matters, your personal tax matters, if you're a business owner, your corporate tax matters, and they can advise you and guide you on your taxes as well. They can help you with IRS tax audit. So that's the Science CPA Services. You can give them a call at 908-888-8900 or visit their website, which is sciencecpsservices.com. With that note, I'd like to welcome Mr. Ajay Kumar of Science CPS Services. Ajay Kumar is a CPA, CVA, and MBA, and he's been part of Science CPS Services with over 25 years. Every week he joins us in the show to guide us and to inform us about the tax rules, regulations, and the more details on the taxes matter. Ajay, good to have you.
Thank you, Sanjeev. Thank you for the kind introduction.
Yes, absolutely. You're most welcome, and you deserve it. Now, viewers, before we begin this show, I want to tell you one thing about this country. This country is obviously, there are two important things in this country. One is immigration. The country is built on immigrants, and the country is very, very competitive, very aggressive in the innovation. United States of America, the prosperity of this country has been strongly rooted on innovation, innovating new products, whether it's a technology, whether it's a household things. So innovation is a very competitive landscape in the USA. I remember reading an article somewhere that they get so many requests about innovations, new products here and there, and they just have to go through it to see which one can work, which one cannot work. The reason I'm saying innovation is because that point leads to R&D, research and development, because once somebody has an idea about the product that they wanted to invent, obviously then R&D follows. And how that R&D and innovation can be added, included, offset in the tax return, that is the key thing. So we're going to highlight corporate tax returns and R&D and innovation tax matters in those tax returns. Right, Ajay?
Absolutely. If this country is known for anything, it's for bringing the brain here through immigration, through other channels. And then this is the country that's leading the whole world in research and development.
Yep.
And the country promotes it. The system, the IRS system promotes it. There are a lot of credits, a lot of benefits that are made around encouraging companies to do more R&D. And that's what we are going to be talking about.
Absolutely, Ajay. You're going to tell us, the R&D cost or the innovation cost, how are they reflected on the tax returns, what kind of benefits the companies get when they invest heavily into research and development. And this is all to encourage those companies to come up with the product, invest in research and development, and then come up with something else. And that's what government is really offering them incentives. So let's start with the R&D. If company has R&D department, how does that matter with the taxes?
Absolutely. Let's first define what the R&D means. And then we see it doesn't have to be a department or separate department, for example. So research and development means you're researching something new or trying to improve something. Expenses related to that exercise are by definition R&D expenses. Now take an example. You are running an IT consulting company or a staff augmentation company where you have few people on your staff and you're hoping the client will take it. But sometimes not every employee is assigned to a client. The client have not taken them. And we call it bench strength. There are people on the bench or who are trained and waiting to be placed on the client side. So a lot of IT consulting company will use the bench strength to create something new, a time sheet system or a performance tracking system or a KPI tracking system. And these softwares, these intangible assets can be then further sold to other clients. So they're trying to improve something. They're trying to create a new software, new system while they are not using the staff. So in that case, you can use that expense, not just the staff salaries. If you had to outsource some work to somebody, 65% of that amount. If you have a separate room, rent for that area. So it's not necessary for the companies to have a separate R&D department. In pharma companies, you always have a separate R&D department. It's easier to justify in pharma companies, in medicine field, but even in the IT consulting, even in the AI field, while you're trying to develop the next application, trying to find the next idea, you're researching a lot and you're spending a lot of money until you hit that gold spot. All those expenses can create a tax credit, tax benefit. They're just not an expense only. Of course, they're business expense, but then there is a tax credit angle to it. That's what we want to bring to your attention.
Okay, so when there's a tax angle to it, obviously that's a good point to know. Are there any limitations on the amount or the percentages? And now that does it really help the company to reduce the tax liability, or it's an incentives that they are getting it which reduces their taxable income?
Both. If you play it right, you can not only reduce the tax liability first, and then whatever the leftover amount of the R&D expense is, you can use that R&D expense, the leftover amount, to reduce the taxable income. Meaning you cannot use the same dollar for R&D credit and R&D expenses. But first claim the R&D credit. Take an example. Say, for example, you want to calculate R&D credit. So in this example, let's say you invested $100,000 on all the R&D related work. And again, the outsourced work is 65%, in-house, including salaries, is at 100%, and it has to be domestic, not international. And let's say this number for this example is $100,000. So out of this 100,000, you can choose two methods. You can choose an easy credit method, or you can use the regular method. In the easy credit method, you generally get about 14%. So in this example, you get $14,000 of R&D tax credit, which will reduce your tax liability dollar for dollar up to $14,000 in this example. The remaining $86,000 can still be claimed as an expense. So the idea is most people will put the R&D as an expense on their P&L. And a lot of people are doing it and they're saving the money. But they're missing almost 10% of the credit. Let's say if you put $100,000 as an R&D expense, if you are in a 20% tax bracket, you save $20,000. But if you take $14,000 as a tax credit first, and then use $86,000 at 20%, you got another $17,200. So you got $31,200 of tax credit as opposed to $21,000. So you save almost 11% extra in this example. Higher the income slab, more savings you will see. The idea is first see if you qualify for a tax credit, and then on the leftover amount, you try to claim it as an R&D expense.
Okay, interesting. So when you sit down to do a tax return, I assume that what you do is that, okay, let's see with the expenses, see what the tax number comes out, right? And then without the expenses, going to the tax credit to see which one benefits most, and then you take that option. And in some cases, maybe expenses work out better. Otherwise, in some cases, tax credit.
Well, unless the R&D expenses are really low and
expenses are high.
I'm sorry, the other way around, if you think about it. Unless the R&D expenses are really low, in the sense, let's say if the total R&D expenses are $10,000, and to create this paperwork to justify the R&D tax credit is going to cost you $5,000. There are special companies, there is CPAs who will do this R&D tax credit calculation for you. They will create this form 6765 for you. And that is an expensive process, cost few $1,000s. So unless the saving justifies that documentation, it doesn't make sense for you to do it. The only time you wouldn't consider claiming the tax credit when your R&D expenses are just very low, not high enough to go there. But generally speaking, if you have $10,000, $20,000 plus of R&D expenses, you should look at the R&D tax credit first.
Okay. All right. So now, with that note, you mentioned one thing. It has to be all domestic, nothing overseas, right? That cannot be taken.
Well, no,
on a tax
domestic
return.
can still be claimed, but domestic R&D expenses can be claimed immediately and can give you an R&D tax credit. If it's international R&D expenses, outside this country R&D expenses, they have to be put as a capital asset on the balance sheet and they must be amortized over 15 years. Domestic credit still have the option to be amortized over 5 years, depending on how much income you have and depending on what tax bracket you fall in. If you're a growing company and you don't have any income to offset, maybe you don't need the R&D expense or R&D tax credit. You can choose to have R&D amortized over 5 years for the domestic R&D. International R&D doesn't give you that option. International R&D expenses must be amortized over 15 years.
Okay. Very well. So now, having heard R&D tax credit and R&D expenses, how they reflect on the tax forms, that's what we have gotten so far. With that note, we're going to take a break, and when we come back, we're going to take this discussion further, go a little deeper in R&D. That what are the expenses covered under R&D? Because it just the name says research and development, but there are a few categories. What's to be deductible, what can be included, what not. That's all coming up right after this messages. Stay with us. Welcome back to the second half of the Tax Talk with AJ. This weekly show, as you know by the title, that's all about tax discussion. Discussion on the taxes for your personal or corporate tax matters, and AJ gives us all the important guidelines that we really need to know when it comes to taxes. During the season, off season, it's not like once the taxes are filed April 15 through October 15, there's no tax talk. No, there's always something to talk about taxes, and that's what we discuss. Right before the break, AJ told us about R&D tax credit and R&D expenses, which one of them reflects on a tax form, but each and every single company's R&D department, their situation is a bit different. Now, to take this task further, my question to AJ is that what's included in R&D? Of course, R&D, when we talk about R&D, we visualize a big facility, many people working in there are a lot of supplies, and of course there's a payroll, meaning wages involved, and supplies involved, and a building cost, and everything else is involved. So how does that work? You take the sum of all those categories and put it on a tax return, or you can only take percentage of certain categories?
A very good question. So for R&D expense, everything is a fair game. Anything that you can think of is a business expense related to R&D is acceptable. When it comes to R&D credit, there are certain limitations around it. But I want to remind all our viewers that as much as when the word R&D comes, we think about the IT companies, we think about the pharma companies, but R&D is not limited to IT companies and pharma companies. R&D could be anything. You are making a flute, and this is better than anything else you have seen. Meaning R&D is not related to certain sectors only. But when it comes to the credit, not the expense, R&D credit is limited to the wages, meaning the salary of the employees who are working on the R&D, the supplies needed for that particular part, especially the external R&D. If you are taking any help from people who are not working for your company, the external help, that's limited to 65%. Wages, 100%, supplies, 100%. But going back to your example, Sanjeevji, if you have a building, can you put the depreciation of the building as an R&D for credit? That's not allowed.
Okay.
So R&D credit has certain limitations. R&D expense allows everything.
All right. So whatever the limitations are there, and that is for the all kind of categories, meaning there's a technology, there's a pharmaceutical, there's a, even for, let's say, to make a piece of furniture, there are R&D involved, right? A piece to manufacture a musical instrument, R&D involved.
Absolutely.
So this 100% wages and the supplies and everything, that's for all the categories, right? It's not like only certain category gets something.
Absolutely. For R&D credit, It's limited to certain expenses, but those expenses are not limited to a particular industry. It's applicable to all industries.
Okay. Now, having said that, what about R&D expenses? How
So
do they
for R&D
calculate it?
expenses, the advice that we are trying to convey in this show, we want all our viewers, if you have a business, if you have R&D expense, try the credit first. Whatever is not claimed in the credit, all those expenses can be claimed as an R&D expense 100% on your tax return if it's domestic R&D expenses that you have. If it's not domestic, then you have to amortize it. You have to put it on the balance sheet and amortize it over 15 years.
Okay, so balance sheet and okay, now the question is amortized for 15 years. That means if the company has R&D department, ongoing department, for example, I'm just hypothetically speaking, right? Let's take a Johnson & Johnson. And they're a big company. They continue to do R&D research on different drugs and medications to see which one works, which one not work. And they have ongoing this R&D department. So take that company, for example. So every year they will have this kind of expenses on their corporate tax return, right? It's not like they can only do it certain amount for so many years and after that it cannot be done.
Well, there are two parts to it. For big companies like Johnson & Johnson, when they have a separate R&D department, they have something going on every day, all the time anyway. And when they're working on something, not everything is a proven project. They're trying to find the new medicine. They have to try 50 different things to make something work. So R&D has to be a proven concept that you're trying to develop. A lot of times, until you know that this is proven, this cannot be amortized. So you keep collecting all the expenses in a bucket. Once you see that this is proven, now this you can have a second version, an improved version. Let's say if you're developing software, it could have version 5, then you can have version 6, version 7. But while you're developing it, you cannot amortize it. It has to be a piece that's usable, that can be put in service in order to qualify for amortization.
Okay, all right. Okay, having said that, let's go a little more further. I want to bring in this angle. One big beautiful bill act known as OBBA, right? Has anything changed for the year 2025 under that OBA tax thing?
Yeah, absolutely. So OBA is allowing the 100% reduction. Prior to OBA, when we had Tax Cut and Jobs Act, that set 5 years amortization even for the domestic R&D. So there are a lot of changes that OBA is bringing, a lot of benefits for making US type of idea, do more R&D locally, domestically type of idea. So they are not touching. Under the TCJ, Tax Cut and Jobs Act that came in 2017, international R&D was still 15 years. They did not touch that. It was 15 years. Under OBA, it's still 15 years. But the domestic R&D that used to be amortized over 5 years can be expensed immediately, 100% now.
Okay, interesting. Now, for a moment, let's just go on a sidetrack a little bit. Personal tax returns. If somebody comes up with the product, somebody thinks of some product, and they do their own creation in their garage. I'm just using that example. And they spend X number of money on their, of course, their own payroll, their own hours rather, and then supplies and everything else. And it's just a personal tax return. They are not sure what to do, what not to do, but they want to see that if product really is developed, then they can take it further. So the money spent and the hours spent and all the resources and everything in the garage for that individual, for the individual, would that reflect on their own tax return?
It can, it should. But you have to be careful. This area can be misused by the system, by the taxpayer. So you have to let the system know it's not a hobby. Meaning, hobby losses are not deductible. While you're developing this product, you're not making a lot of money out of it. So more than likely, you want to claim the expenses without any revenue. So you want to claim some tax deductible losses over there. So first step is to justify that it's not a hobby, it's a real business, real product that you're trying to develop by forming the LLC, by having a separate space, by having a website, by having the business card. Justify to yourself, to the system, that it's a legitimate business, not a hobby. Once you have crossed that road, that is not a hobby, it's a legitimate business, then you have to keep proper documentation. What you can claim is the money that you're spending. You can't really say, I spent 10 hours, I should be getting $10 an hour, so I spend $100. The time value of money is not a deductible expense. But anything out of pocket, you can't really say, I'm using the garage, so I want to claim the rent for it. Then we'll say, who are you paying this rent? Oh, to myself. It becomes taxable income to you then. Then it's a wash. It's not adding any value. So home office expenses are limited to $5 per square feet up to 300 square feet. And then it needs a lot of documentation. If you're just starting up, keep it clean, focus on out-of-pocket expenses, don't include the time value of money, and make sure you justify to the system by proper documentation, by having the LLC, having a website, or having the business card, having membership to some networking groups, that it's a business, it's a legitimate product that you're trying to develop, it's not a hobby.
Okay, all right. We got now literally a minute left in the show, and I have one quick question. You mentioned startup in your answer. So if there is a startup company and they really believe in this product and everything is going well, right? So my question to you is, when there is a startup company, do they directly can come to you, or they really need to go to a professional R&D professional to have some kind of report done which you can use it in order to prepare their tax return?
Well, it's a different field. We do R&D expense, R&D credit reports. Not all CPAs do. So if you are going to your CPA and your CPA is advising you that they need a third party, you can always hire a third party. But there are a lot of CPAs who will do that work as well, meaning who will go through the paperwork, who will help you understand, justify. A lot of payroll companies do it. All payroll companies, the big ones, you can call them if you have the payroll with them, because the biggest expense in the R&D credit is the wages, is the salary. People who are doing this R&D, they are typically highly paid people, high salaried people. So the biggest expense happens to be the wages, the salary. A lot of payroll companies started to do this R&D credit as well. So you have a lot of options out there.
Right. Okay, so you have option available. But having said that, of course, you heard from AJ that they do it. Sai CPA Services can do it for you. And that's why I'm saying that they are the most knowledgeable, full-fledged professional accounting firm located in state of New Jersey. If you're not in New Jersey, if you're outside somewhere in the USA, don't worry. They can assist you with the Zoom call or over the phone, or anything is possible. So do reach out to Sai CPA Services for this matter or any other tax-related matter, 908-888-8900, or visit saicpaservices.com. With that note, AJ, thank you so very much.
Absolutely, my pleasure. Thank you.
All right. And again, I'm Sanjeev Pandya, wishing you all happy and the tax-free days ahead. So long.